Well, up here in the dog park on Mount Tumalo with Miss Nadja, and somebody, not saying who, but somebody forgot to bring a toy to throw. So somebody's kind of bored. So today's topic is going to be the incorrect use of joint ownership. So this is a mistake I often see in estate planning, where people rely on adding someone to a piece of property so that it'll pass at their death outside of probate. And that is true, it will. But it comes at a pretty significant cost and risk. So the problem with joint ownership is when you add someone to your property, a lot of times you've given away a big chunk of that property. So that's a gift. And it might require the filing of a gift tax return, depending on how much it is. In addition, they are now a current owner of that property. So if they run into any kind of difficulty, such as lawsuit, divorce, debt, your property could end up getting tied up in their affairs. So that's another instance where you may regret having someone on your property. One of the other issues is stepped up basis. So when people inherit property at death, they get what's called stepped up basis, which reduces the amount of taxes they'll have to pay when the property is sold. If you transfer some of that during your lifetime, however much you actually transfer to them, you're taking away that stepped up basis. So now they're going to pay additional taxes when that property is ultimately sold. So owning property jointly with anyone other than a spouse, usually a big mistake. So I would definitely recommend against it, especially since there's better alternatives. Beneficiary designations work very well. Using a trust works well. So I'm going to head this one under a mistake. So definitely when you're doing your estate plan, don't make that mistake. And if you learned something from this video, which I hope you did, please like and subscribe below. And if you have any additional questions, just add them to the comments or contact me through my website.